investing in a rising tax environment.
My name is Andrew Taylor, and I will be hosting the event this evening with my colleague, Kim Renners. A quick bio on the two of us. Kim is an investment manager at OJM Group with over 18 years of experience in the financial service industry. Her background includes a prior responsibility for the management of over $4 billion in assets in an insurance company. Kim holds an MBA and is also a CPA, although not actively practicing. This diverse skill set makes her eligible for bad jokes around the office directed towards both financial advisors and accountants. In all seriousness, I would consider Kim to be an expert in the field of fixed income investing, and she's led the movement of OJM into a focus on some of the non-traditional asset classes that we currently utilize, which is one of the factors that I feel makes our firm very unique. My background is in managing money for affluent individual investors, something I've been doing for 15 years. I'm also a certified financial planner, which is a board certified designation. Like Kim, I'm also an investment manager at OJM. Enough about me. Let's get into the agenda and what to expect from the webinar. You will have the opportunity to ask questions throughout the presentation, and we will conduct a few poll questions to make our discussion as interactive as possible. On to the topics for this evening. As of this moment, there are a series of changes to current tax law that are scheduled to take place, barring some type of congressional action. And one of our goals this evening is to provide some education on this subject. What are the proposed tax changes? What exactly is the fiscal cliff? And who is going to be impacted? The OJM investment team is always very forward-looking with our analysis. We've spent quite a bit of time evaluating the potential impact of the pending tax changes to the markets and the economy, and we'd like to share some of that information with you. After coming to an understanding of the present situation, the next question to ask is, how can you best prepare yourself for what is likely to be an increasing tax environment? We hope to provide you with some answers this evening, and then at the conclusion of the webinar, we will answer the questions we received throughout the course of the presentation. We do have a disclaimer that you will see as part of any standard investment webinar. I certainly don't want to read this to you in its entirety. I know everyone's excited to hear that piece of news. However, the point that I would like to make is that our tax code is very complicated. Specific individual circumstances can vary drastically, and it is critical to have a discussion with your tax advisor prior to taking action based upon any of the material that we cover this evening. Many of you on the call are new to our firm, therefore there's a need to answer the question, who is OJM Group? We are a wealth management firm offering multidisciplinary planning to our clients. Our staff has a very diverse skill set. Many firms express a desire to quarterback their clients' financial relationship. However, very few have the expertise in-house to successfully execute in this area. We believe we have a great story to tell at OJM, and this was the key reason I was willing to leave a successful established practice at my prior firm that I had continued to grow and build for nearly 13 years. I know Kim would tell you that the OJM story is the same reason she made the decision to join our organization. One person cannot possibly be an expert in each of the areas you see listed here in front of you. However, a coordinated approach by numerous professionals working together does allow us to provide an integrated planning solution for our clients. On the next slide, you'll see we have written several books, which we are very proud of. And as a thank you for registering for our call, OJM will send you a complimentary copy of any of the books you see here in front of you. Not pictured, but also available is a book called Wealth Secrets of the Affluents, which is designed for investors who are not physicians. A few sentences about the investment team at OJM. We are an independent fee-based registered investment advisor managing customized portfolios for our clients on a discretionary basis. Kim and I, as well as the rest of the investment team, focus solely on asset management. What I feel makes us unique is our emphasis on utilizing alternative investments as a component of a client's portfolio. Our team's constantly looking for ways to manage risk, to reduce portfolio volatility by finding vehicles that have a low correlation with traditional equities markets. We certainly can't eliminate the risk associated with investing. However, we are a strong believer in the concept of non-correlating assets. And I think that the benefit of this philosophy is best illustrated using, an extreme case where some equity investors actually experienced in 2008. If a $1 million portfolio experiences a 50% loss in value, it's going to require a 100% return to get back to that $1 million threshold. And on to the new investment tax. So before I get into the series of slides throughout what makes up the core of our presentation, I think it may be useful to spend a few moments discussing historical tax rates, our nation's position in relation to the rest of the world on the subject, and to determine exactly how did we get into a situation where we are on the verge of such a significant series of changes. So please bear with me. It'll be a couple minutes before I get to the next slide. As you can see, our poll question will be coming up in time. But I'm going to speak for a moment about GDP and gross domestic product, which is a measure of the goods and services that a country produces over a period of time. So why does GDP matter? Well, it's a way for us to measure growth. It can also be used as a reference point when we compare ourselves to other countries or when we evaluate particular points in our own country's history. We're currently in a period of slow growth with GDP increasing at a rate of around 2%. Now, the historical average growth rate for the United States is around 3.3, and most economists would like to see that number closer to 4% during a period of elevated unemployment when we're coming out of a recession, and this is the scenario that we currently find ourselves in. An optimal scenario for any country would be to see wages grow, corporate profits grow, home values increase, all while containing inflation. Now, this may sound like a Pleasantville scenario and maybe a bit unrealistic, but what I've just described actually maximizes tax revenue. It makes it much easier for our federal governments to balance its budget, and the same can obviously be said for state and local governments. In a perfect world, when times of prosperity do occur, government spending is properly managed, and we would actually have a budget surplus. Today, if you bring up phrases such as budget surplus and prosperity in a room full of people, you're likely to get a reaction of sarcastic laughter. So while a strong argument can be made that government spending wasn't managed the way it should have been in prior years, we did experience prosperous times and tremendous growth throughout most of the 90s, and our country actually ran a surplus in the late 90s and into the beginning of the 21st century. So what happened? Well, terrorist attacks occurred in 2001, and the subsequent increase in military spending were significant factors that initially moved us into the red. But of course, the larger issue was the global financial crisis of 2008, where we went from a $160 billion deficit in 2007 to a $1.4 trillion deficit in 2009. And budgetary problems begin to develop when growth slows because tax receipts fall more rapidly than expenses can be cut. Governments are typically slow to respond to declining revenue. Any single change to even a dollar spent has to be negotiated in some form or fashion. So very simple math suggests that government revenues are going to plummet when A, there's less income to tax thanks to double-digit unemployment, B, home values decline by 30% or more, and C, there's a drastic decline in consumer spending, which equates to lower corporate profits. All the scenarios that we experienced in 08 or 09 are issues that we're still attempting to recover from today. So economic theory is mixed on the optimal way to recover from a recession. There's a difference of opinion that extends to Congress, and it's a contributing factor to the stalemate we find ourselves in as it relates to fiscal policy. So the question is, do you stimulate growth through aggressive fiscal spending, or do you continue to lower taxes to increase business investment and individual discretionary income? Well, the cost of either action results in some form of deficit until a reasonable level of growth is achieved, and the problem is there's a limit to how far you can extend each policy. Enough about economics and GDP. Let's take a look at where we stand relative to the rest of the world when it comes to tax rates, and this brings us to our first poll question, which you've been staring at for the last 5 minutes, so thank you for your patience in allowing me to get to this point. But what country has the world's highest tax rate expressed as a percentage of GDP? Now, while I guess you've had plenty of time to answer the question. However, there were several ways you could calculate this. We felt that using gross domestic product was probably the fairest way to evaluate this number. So let's go ahead and take a look at the choices. And the results actually were pretty impressive. Those of you who chose Denmark were actually correct. They are first with a tax rate of 48.2% of GDP, which is slightly ahead of Sweden. Italy comes in third. The rate of the U.S. is actually 24%, which is the third lowest, Mexico being the lowest in the world. Now, in the interest of full disclosure, if we were to isolate the numbers to corporate tax rates, we would find the U.S. is at the top. Japan recently cut its corporate tax rate as of April the 1st, and as a result, the U.S. now has the highest corporate tax rate in the world by at least one measure. The statutory tax rate doesn't necessarily tell the whole story. There are loopholes and other special treatments for businesses that make the effective tax rate much lower. The U.S. Treasury would tell you that the U.S. falls below the average of other major economies. President Obama and Republican candidate Romney are on record as saying they would like to cut the corporate tax rate. The difference lies in where they believe that rate should be and to what extent incentives and loopholes should be permitted. So back to our presentation, you're looking at a graph illustrating the top marginal rates in the U.S. In 1950, the top marginal rate was 91%. Today we're at 35, which represents a decline of over 61%. You can see in the chart we reached a point where the top federal tax rate was 28% in 1990. However, we're currently at a relatively low point in our nation's history when it comes to the top federal tax rate. It may not make you feel any better. However, I think there's some value in understanding the history of tax code and where we're coming from. So let's take a look at the current path in which we're headed if no further congressional action is taken. We have two key events scheduled to occur at the conclusion of 2012. The scheduled expiration of the so-called Bush-era tax cuts and the new investment tax, which is part of the Affordable Care Act designed to help fund the cost of the President's health care reform strategy. So the numbers on the slide would be what we call a worst-case scenario. The top income brackets would all rise. Long-term capital rates for many taxpayers would jump from 15 to 20%. The Affordable Care Act would also kick in and assess a 3.8% tax on investment income to certain individuals, which would impact both dividends and capital gains. There's also a 0.9% tax on wages of high-income earners as part of that same package, which is not expressed on your slide. And you can see that long-term capital gain rates could potentially increase to 23.8%. Then the larger, perhaps more eye-opening change is the impact on qualified dividends. A lack of action by Congress means that qualified dividends would be treated as income, and if we revert back to those 2002 tax rates, the top income bracket is 39.6%. As I stated, top earners' dividends would also be subject to the new 3.8% Medicare surtax. So if we're faced with this scenario, tax-free investments obviously become very attractive in non-retirement accounts. The 3.8% surplus, this tax applies to passive investment income. We've included some of the categories that will be subject to the new tax. Interest on savings accounts, the The taxable portion of annuity payments not included here would be income from the sale of a home above the $250,000 and $500,000 exemption threshold for individuals and married couples. Just a few of the items that will be impacted. Next question would be, who is affected? Both the 3.8% surtax on the passive investment income and the 0.9% tax on wages are subject to the same thresholds. So a single taxpayer with modified adjusted gross income over 200K, as you can see, or married taxpayers with a modified AGI above 250 would both be subject to the tax. Now, how to apply this, or how exactly would this work? For example, if an individual has a modified AGI of 201K, and Kim, if you could back up, that $1,000 would be subject to the 0.9% tax on wages, so the full $200,000 would not be subject to that tax. Another example, if an individual had $60,000 in wages but realized $180,000 in capital gains, total compensation would be $240,000. $40,000 of that would be subject to the 3.8% tax on passive income. So as we move back to the slide, you can see the impact of the potential tax increases, with the most alarming change being the 289% tax increase on dividends received by those in the top bracket. Finally, you'll notice there are state tax implications resulting from the stalemate in Washington, and the impact is significant. But for the purpose of this call, given our time constraints, we won't address the subject in any level of detail. So on to the looming fiscal cliff. Hopefully you'll find some humor in our picture of poor Uncle Sam leaning over the cliff. What exactly is the fiscal cliff, and why have we heard so much about it? Well, let's start with the definition, and I really can't state it in a way better than how it's written in front of you in the first bullet point. It's a series of fiscal events scheduled to occur in 2013 that's resulting from a significant decline in government spending and the expiration of multiple tax cuts. So the impact on the economy could be rather significant. We'll get into some of the details shortly. But the philosophy of kick the can down the road in Washington because of the inability to compromise has led us to this point where uncertainty regarding the political landscape in the country may have reached an all-time high. Momentum is gaining amongst both parties for significant tax reform and to simplify the tax code. So when we do have a resolution, there's a reasonable chance that it will remain policy for an extended period of time. Let's look at the spending reduction scheduled to go into effect if no congressional action is taken. So the first round of cuts resulting from last year's well-publicized debt ceiling compromise is scheduled to take place. Roughly half of this is directed towards defense spending. Some of the other items, the temporary extension of the unemployment benefits are set to expire. Many of the publications that we read have referred to the last two items on your screen as low-hanging fruit. Therefore, it appears very likely that Medicare reimbursement and a mix of various investment incentives will also go away. Our next slide will highlight some of the remaining tax cuts scheduled to expire, the ones that we have not addressed to this point this evening. Employees' share of payroll taxes, which were temporarily reduced in 2011. The alternative minimum tax, it's been an absolute mess for some time. The rules have not been rewritten. No one seems to have a solid plan for how to restructure it. Doing away with the AMT is not likely unless it's part of a much larger reform package, because the revenue loss would simply be too significant. I think the most significant issue regarding the item on the bottom, the charitable IRA distributions, by allowing that benefit to go away and no longer allowing the funds to go directly to a charity, an individual could potentially avoid the negative impact that the IRA minimum distribution traditionally would have on Social Security and Medicare benefits. So that option will no longer be available, again, barring some type of action from Congress. And now we come to our next poll. What do you think will happen? And you can see the three scenarios. So do you feel that we will experience the dreaded fiscal cliff? Do you feel that the Bush tax cuts will be extended, the payroll tax cuts expire, but there's no automatic spending cuts? Or do you feel like all current policy is extended for 1 year? So we will give everyone just another moment to vote before we show our results. And obviously there's no right or wrong answer here. So it looks like most feel that all current policy will be extended for 1 year. And we will give our opinion here shortly. So my last two slides of the evening are coming up before we transition to Kim. First, I want to address the economic impact of the fiscal cliff. So the combination of tax increases and spending cuts equates to a number in the range of 600 to as high as $700 billion. Now, this goes a long way towards balancing the budget, at least in theory. However, the result is estimated to, the resulting impact is estimated to reduce GDP by 4 to 5%. Now, gross domestic product growth is projected to come in around 3% next year without accounting for significant changes to fiscal policy. So, therefore, the result of the fiscal cliff would likely mean negative GDP growth for 2013. Now, 2 consecutive quarters of declining GDP is widely viewed as a recession. So what do we think will occur? Well, the facts are that last month, Fed Chairman Ben Bernanke encouraged Congress to act prior to the end of the year to avoid a fiscal cliff. 2 weeks ago, Kim and I had the opportunity to hear a vice president from the Federal Reserve speak in person, and he reiterated that being independent, the Fed's position is to stay out of matters relating to fiscal policy. Now, for Bernanke to suggest a course of action to Congress suggests how strongly he feels about the impending fiscal cliff. His point is that with unemployment at 8.3%, GDP growth where it currently stands, the economy is too weak at this moment to overcome the series of events scheduled to occur at the conclusion of 2012. So we feel that Bernanke's word will carry some weight with Congress, and while higher taxes are very likely to occur in some form in 2013, a fiscal cliff scenario where all of the spending cuts and tax increases occur is not the most likely scenario at the moment. Some combination of each does appear likely at this point. However, another year of kick the can down the road certainly cannot be ruled out as a possibility. Now it is time for the long-awaited appearance of Kim Renners. So Kim, at this point, I am going to turn it over to you.
Okay, great, Andy. Thank you. Hopefully everybody can hear me. We're going to move forward here on the slides. And, really Andy gave a great synopsis of OJM Group and what we do here at the firm. And really, our steps in any process when a client or prospect comes to us is all about education first. And that's really what Andy tried to do with the group today, is educate you on, what are some of the potentials of going into year-end with the fiscal cliff, what are some of the potentials with the tax cuts, not extending or extending, and then just to give a good description of all of this. The next step in our process would typically be to analyze your personal situation. So analyze your investment holdings, your life insurance holdings, your entire financial plan, and then make recommendations, right, as our second step. And lastly is implementation. And that's what I wanted to focus on a little bit for the next 15 minutes or so. With everything that Andy said, and there's a lot of possible scenarios out there, what can you do now to help offset some of the worst case scenarios of your taxes going higher? So let's talk about a few of those items right now. So one of the first things we really thought that you could do, you could push forward to this year, is to sell assets and take advantage of our current capital gain rate of 15%. So that could be a business asset that you own. I mean, this can be outside of your stock portfolio. It could be a concentrated stock position, maybe that you've held for 20 years. Microsoft, you bought at IPO 35 years ago. Might be time to take some of those gains off the table. There was actually a really good study recently that said if asset values grow by 4% per year and the cap gains rate increases as scheduled right now from 15% to the 23.8, so 20 plus the 3.8 Medicare tax, right, for the highest brackets, an investor would actually have to hold assets for an additional 15 years to be better off than he would be or she would be had they actually sold the assets and paid the tax in 2012 at this rate. So you can see it's a very big hit that could be potentially coming here in the future with capital gains. So we don't know if that's going to change. We were actually in a meeting this morning talking with one of the partners, Jason Odell of our firm, and he just came back from Washington, D.C., and so he was talking with a lot of the lobbyists and such out there. And, I had talked to one investment manager just prior going into that meeting, and their take was there was going to be an extension of the Bush tax cuts for just 6 months into the year, but then that would just give the government time to get things done, because obviously you can't just extend for 6 months. You don't know what the tax code is. So Jason was saying that he was hearing from the people in Washington that there would most likely be an extension for a year, kind of like what most of the people surveyed here thought today. The majority of us said, okay, well, I think there's going to be an extension for a year. And but that could change as well. I mean, there's a lot of things. There's a lot of moving parts, right? So we have an election coming up. There could be some shocks to the system, etc. So as you're thinking about potentially taking gains this year, think about it now. Because if all of a sudden there's no extension of the cuts, we're going to higher rates in November, December time period, everybody starts selling, guess what? The market's going to go down. There's going to be that much pressure on the market that's going to force prices to naturally go down. So you have to be very cautious of that. I will say that one good thing about, if there's a good thing in this, about this issue is if you have an appreciated asset, like Microsoft in my example, but you still like the name, if you have a gain, you can sell it this year, pay your tax, your 15% tax on your gain, and then you can immediately buy it back. So you always think like, well, I still like that name, Kim, I want to hold it. Well, let's buy it back. There's no reason we can't. There's a wash sale rule, which really requires investors to wait 30 days to buy a stock back if you took a loss on that sale. And the government says, well, you can't take a loss and then buy it back the next day and write off that loss. We're not going to allow that, so you can't buy that back. In the gains, they don't care. They're going to tax you on the gains, and you can still buy that stock back if you really wanted to. So something there to think about. So step number one, consider selling appreciated assets, during the year of 2012. Step number two, if my computer would move my screen here. There we go. My favorite subject, municipal bonds. So Andy said I had some past experience in managing fixed income portfolios, which I did for several years, and munis was kind of my specialty, and I always like to call myself a bond geek. For those of you on the phone, you've probably heard that before. But consider municipal bond investments. And I know if you're one of our clients already and you're on this call, there's a good chance you already own municipals in your portfolio if you have a taxable account, because they make sense and they've actually been very cheap in a sense when it comes to treasuries versus treasury bonds, or even versus some of the corporate credits out there. If you think about how that would work with the municipal bonds, if tax rates increase, demand for municipal bonds would also most likely increase because, people wish to reduce the tax they pay. And then on the same hand, as tax rates rise, the effective interest rate on the municipal bond also increases, just naturally. Because if you do, a tax-effective yield calculation on a municipal bond versus a treasury or a corporate bond, because you're receiving interest that is not taxed by the federal government or maybe even the state government, if you live in a state where there's income tax and you own that particular state bond, that calculation, your tax bill is less because you're receiving more interest, in effect, tax bill being less. This particular chart here is just saying, Medicare contribution tax, sunsetting of the Bush tax cuts, what possible effect it could have on a 7-year municipal bond versus a 15 to 20-year municipal bond. And you can see that the rates or the values of the bonds will most likely move higher. Now, some of you might be thinking, well, Kim, there's been these defaults and these bankruptcies in the state of California. I don't really know what to buy. It doesn't make sense. They scare me. I don't know enough about it. Well, I like to always show this slide, too. This is tax receipts, U.S. state and local government, March 2007 to 2012. So you can see the dip there at the bottom of the market in the, right around the second quarter of 2009. Since then, tax receipts have just moved higher, almost in a straight line, a little dip in the second quarter of 2010. But look at that. They're higher than, tax receipts are higher than what they were at the peak of the market in 2008 before the financial crisis. So that's a good thing. That's a good thing for municipal bonds. Now, you have to be careful, obviously, in what types of municipal bonds you buy. And you have to have, somebody picking those individual bonds or those bond funds for you that has that background. Because absolutely, there are municipal bonds out there that are not traditional munis, as I like to call them. Andy and I were talking about them a little bit earlier, today. Healthcare bonds, so bonds that are issued by a hospital and you have the hospital credit behind it, per se. Those are the bonds that are going to be more likely to default if a hospital system has issues. Same thing with airline municipal bonds. Those are out there. American Airlines filed bankruptcy last year, and those bonds default. So there are going to be defaults in the muni space. They're much lower than any other, bond asset class aside from treasuries, of course. And you just have to know that the defaults that do occur are not in your traditional water revenue bonds, sewer bonds, general obligation tax bonds. Those typically don't occur. So I like munis. I really like munis in this space. I like munis in a taxable brokerage account regardless, especially in the high tax states, California being one of them. Ohio, you can build out a nice Ohio municipal bond portfolio, ladder it out. Sure, you don't need the income now. You're young. You're still generating wealth. But in the future, when that muni portfolio grows to be $1 million and you're receiving, that 5% interest income per year and not paying any tax on it, that's going to be a nice little supplement, to your income in retirement. Okay, so let me get off that horse and let's move on here a little bit to a few other ideas as to how we can go ahead and, act now. What can we do now? These are just some basic steps, purchasing stocks to hold long term. So not having a lot of turnover in your account. Again, using tax-efficient investments in taxable brokerage accounts. So municipal bonds are obviously tax-efficient investments. They're not going to give you that great home run type of return. They're going to be slow and steady, 4 or 5% per year, maybe 6%, 7% some years. If you want to get more growth but yet still have tax-efficient investments, there are exchange-traded funds out there that may buy, stocks, a stock asset class, let's say large-cap U.S. stocks that pay dividends. And exchange-traded funds are good. They're a good diversifier for, a smaller portfolio because you own a collection of stocks. In my example, the stocks are paying dividends. Exchange-traded funds are not known to pay capital gain distributions like mutual funds have in the past. I think, in 2008, there were a lot of mutual funds that were down 30%, 40% during that year. And because they had some, more legacy positions where they still had, gains and they sold them within the fund was in a position where it has to distribute out all of its capital gains to the shareholders. So you lost 40% in performance in 2008, and then on top of that, they distributed out a capital gain that you had to pay another 15% tax on. So that was, the managers of mutual funds are not managing for you. They're managing for their strategy. And there's plenty of great managers out there. You just have to understand how tax efficient they could be, what their turnover is. So we like exchange-traded funds in a lot of those very efficient asset classes. Master limited partnerships, or MLPs, as they're often referred to, are very tax efficient, just like the non-traded real estate investments that we utilize in client portfolios. They pay some pretty hefty dividends, 6, 7% typically. But a lot of that money, a lot of that dividend payment is actually not taxed during the current year. What it does is that dividend comes in and it reduces your cost basis in that particular holding. And so when you sell it, your cost basis will be less. You'll most likely pay cap gains tax, which have historically been lower than your ordinary income tax rates. So we definitely like those as tax-efficient investments in your brokerage account. I think we already talked about, turnover, and of course in the future, if you sell all your gains this year, you can always harvest losses, basically take capital losses to offset gains in future years should tax rates go higher. So a couple other things that are, not as common, I think. The first one here really being considering investing in annuities or life insurance. So let's think about that. So life insurance really provides tax deferral on, any increases in cash value that you would have during the life. And, it's a tax-efficient way, in addition to that, to pass wealth on to future generations. And so you may have a life insurance policy that has an underlying cash value. You put money in, that cash value grows as, as the market performance occurs or the crediting occurs within the life insurance policy, and you pay no tax in that current year. And then if you hold that policy until the death of the owner, you actually, the death benefit is not going to be subject to income tax. And if you properly purchase life insurance and structure it well, the death benefit may also be free from the estate tax, which could be even a bigger issue for some of you in the future. So life insurance is definitely one way to utilize that type of product for tax deferrals. And you could talk to the many experts in-house that we have, Jason O'Dell, Michael Llewellyn, Paul Wilson, about the different life insurance setups that we can offer. Another interesting way to use tax deferrals without really using life insurance are annuities. And there's different annuity platforms out there today, which are popping up more and more, that are not your typical annuity where you lock the money up for 7 years, and there's these fees if you want to take it out, and then you only can get an annuity stream. There's these platforms, and I was actually just talking at lunch today with a new platform out there where you have some, let's just call it a taxable brokerage account that's worth $100,000. And if you invested that money every year, you would pay the income that came in off the dividends, you pay the gains if you sold anything. Well, instead of just leaving it in a brokerage account, let's say you're 55, 60 years old and you want to defer some of the tax on that. Well, there's these platforms out there now that are, I like to call them annuity wrappers. You take that $100,000, you put it into this annuity structure. You pay, there's some small fees involved, but what it does is it takes all the tax you're paying now and it defers it for the future. So you get to invest. Most of these platforms, offer 300, 400 different mutual funds that you can invest in, and you can actually trade the mutual funds like you would be trading your brokerage account, and all of the activity, the dividends, the income, the gains that would occur in any given year from trades or just appreciation is not taxed in that year. So basically it's going to be taxed at a later date. So it's, again, it's a way, there's so many tools out there, and annuity structures are not good for young people, because when you put money into an annuity, anything that grows, when you take it out, you pay ordinary income tax on, you don't pay capital gains tax on. So you have to think about that. So it's definitely not good for younger people, but if you're 55 or 60, it's another way to help with tax deferral ideas. One of the other traditional ways to potentially take advantage of the lower tax rates today is to convert your traditional IRA to a Roth IRA. So we're all eligible to convert at this point. There's no income limits on conversions. If your income is over a certain dollar amount, you can't actually contribute to a Roth IRA. You can actually convert. You can't contribute to a Roth IRA. You could convert a Roth, or you can convert a traditional IRA to a Roth. You'd have to pay the tax, when you file next year. You'd have to pay that tax with, typically money that is non-IRA money, okay? Because if you're not 59 and a half, you don't want to take money out of your IRA to pay tax. You'll be not only you'll be penalized if you take that money out early. So you have to have, obviously, money in the other pocket of your jeans to pay that tax. And you don't have to do the entire conversion this year. So if we're thinking here we have another year, maybe a potential extension of the tax cuts, do a portion this year, do a portion next year. At some point, tax rates have to go up. We have a big, very large deficit here in the United States, and taxes are going to have to go up. I don't know if they're going to go up for everybody, all tax brackets. I mean, honestly, I would guess that they will. So, seriously considering having that Roth IRA conversion done in the next couple of years is something to definitely do. And there's a lot of benefits to a Roth. You can pass that down to your to the beneficiaries, to your children, to your grandchildren. You never really have to take money out of a Roth IRA. Once you hit 70 and a half, you have to start taking distributions from a traditional IRA. So, there's definitely benefits to a Roth. You always want to make sure you have that Roth IRA or tax-free bucket of retirement income. And that's, again, as Andy said, a more in-depth conversation for a later time. A couple of the other bullets on here, just deferring charitable contributions to later years. If you have something this year, do double next year. If taxes go up, then that'll help reduce your tax bill in 2013. And even if you have the ability to accelerate income, bonus payments, stock option exercises forward to this year as an employer, as a owner in a practice, do that and pay the tax this year, maybe for something that you would be owed in January or February of next year, assuming rates go up. So again, we really don't know what's going to happen with the tax rates. We're just trying to give you some very valid ideas to think about as we come into year end here, and even to potentially execute. A lot of these ideas are great for tax planning purposes, but some of them are also just good investment ideas. Andy and I always, he may make fun of me because I have that CPA and an accounting background, but it gives us a really good sense and good knowledge of the space, and we're able to help our clients really plan properly. Because as you can see, let me just move forward to this next chart. You just want to be aware of tax consequences. You don't want, the tax tail to wag, the dog per se. It's really not what you make in your investment portfolios, but it's rather what you keep after tax and after expense that counts. So you want to make sure you have that, advisor team in place that's taking the holistic view of your assets. And as I was starting to say, there's different profiles of every individual out there. You have different types of accounts. Some are tax, some are not. You might live in a state like California where the income tax is extremely high. New York, same thing. New York City. Yeah, you know, your advisor team has to be aware of that. They have to help you plan for that. You know, how is your captive insurance company taxed versus how your individual account is taxed? You know, what assets should you hold in your retirement account versus your brokerage account? You know, so something that's not tax efficient, you know, you should hold in your retirement account because you don't have the tax issues in the current year. You know, something like a bond fund that pays income out, you know, every year. If you hold that in your brokerage account, just your individual, you know, Smith Barney brokerage account or Charles Schwab brokerage account, then you're going to be taxed on that income at your highest tax rate every year. But if that same bond fund was in your retirement account, there's no tax owed, and that can continue to grow, you know, more effectively in that tax deferral. So, you know, I guess what I'm getting at is understand the taxes, understand the expenses, you know, have a good sense or talk to your advisor, you know, and see what he or she may think about where, you know, we're going next year with the tax code, how that's going to affect your decision-making process when you make investments. You know, there's so many things to be aware of, and I know you're all on this call because you're interested in, you know, some actions you could take, and I definitely give you credit for being here as well because you realize that you need educated and you want to be on top of, you know, really what's going on in the future so that you can properly plan, you know, for yourself and for your family. So with that being said, let's see what we could do here. The next page, the next two pages are really, you know, Andy told you a little bit about our firm. We have a group of experts between insurance and planning and investments and, you know, other attorneys, CPAs that, you know, really help you work through the whole planning process, the whole financial consulting process. We've helped, you know, really a lot of clients over the years, and most of the clients that seem to come to us are very concerned about their taxes and how to reduce their taxes. They may own, you know, a small business or a practice, a physician practice, and there's really a lot you can do at the corporate level. There's a little bit less that can really be done at the personal level to reduce tax, but there's a lot that can be done, and we've, you know, generated a lot of good value ideas at the corporate level. So definitely, if you have, you know, have something going on at a small business or a practice level, be sure to give us a call. And I think on the last page, first we're going to do a poll very quickly. We'll open that up, and, you know, just want to ask you, what's the next best step for you? Can we contact you to do a free consult? Can we send you a book? As Andy talked about, everyone gets a book, so let us know if you'd like a book, where we can send it. And we also have an e-newsletter, so let us know if we can sign you up for that as well. This first point here, just real quick, you know, we do, any prospect who's interested in learning more, you know, about the firm, we just ask you to fill out a 3-page data form, as we call it. It gives us a little bit of information about you. And then we have one of the partners get on what we call an intro call with you, just to understand your situation, to ask questions, and then we often just give some recommendations or thoughts based on, you know, what we learned from the data form or maybe what you've told us on the call. This is all complimentary, so I really encourage everybody here, if you're not already engaged with the group, to definitely do this. You know, it's worth it. So last page here, I think we just have some contact information. We're almost at an hour. We kept you a little under an hour. So again, thank you very much for joining us tonight. I hope you learned a little bit. We want to make sure we educated you and hopefully gave you some good ideas to think about going into the end of this year. Feel free to contact us at our 800 number. You know, Andy and I will be back in the office tomorrow morning, or email us if you have any questions, or, you know, if we can really talk further about any of your particular financial situations. So with that being said, thanks again. Have a good evening, and we hope to hear from everybody real soon. Take care.